Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about NIO Stock. In this video, we will be analyzing 3 articles, to where the first one is titled, Don't Let Q4 2022 Scare You Off. So clearly, this author is very bullish on NIO's future projections, even though their Q4 report for 2022 was less than impressive. After that, we'll move on and talk about our next article, which is titled, Is NIO Inc., ticker symbol NIO, a buy as Wall Street analysts look optimistic? So we'll be going over whether or not to buy, sell, or hold this company, as well as what professionals think of this overall company's future trajectory. And then lastly, we will talk about the top 3 best electric vehicle stocks to buy right now, and why NIO is one of those top picks. So for more videos on NIO Stock, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. If you clicked on this video, you probably already know that NIO is an electric vehicle company that is located over in China. And this author is very bullish on NIO, to where he says this company is a clear buying opportunity despite their Q4 2022 earnings report, which brought in less than impressive results and uneasy guidance for Q1 of 2023. However, this author believes that there is good reason to invest into NIO stock, even though the next quarter is not going to be as promising as their past results, but once we get through half of the year, after that, it looks like they have a great growth rate. For instance, the company reported a 60.2% year-over-year increase in their vehicle sales, which overall is very positive. However, their vehicle margins did drop significantly, meaning that they are bringing in less than impressive financial results, even though their overall vehicle sales increased. NIO is a fantastic growth stock, and this author believes that this company is expected to recover both fundamentally and in their share price throughout the full year of 2023, particularly in the back half of 2023. The company had a very rough 2022 regarding economic slowdowns that happened over in China, various lockdowns, higher inflation, a weaker spending environment, as well as heightened battery costs, which lowered their overall margins for their vehicles. But with all of that being said, it seems that NIO is on the recovery, considering that they are well positioned to beat their overall deliveries and boost their top-of-the-line growth and revenues. Over the next quarter, it seems that NIO will not have a very impressive earnings report, but once we get past Q1 of 2023, we can see that this company would be rapidly expanding, considering 2 catalysts, which we will talk about later in the video. NIO right now expects total revenue to be between 1.584 million or 1.58 billion to 1.674 million or 1.67 billion for Q1 of 2023, which is significantly lower than their previous estimates, to where they were supposed to bring in around $2.78 billion. Clearly, Q1 of 2023 is not looking very good. However, after that, this company will go through 2 catalysts, which will pay off in the back half of the year. This means in the short term, the stock will remain volatile, but over the mid to long term, this company looks like a long-term buying opportunity, considering that the share price is anticipated to rebound at the end of 2023. So many investors are buying right now while the share price is headed downwards, and then inevitably, when it bounces back toward the end of the year, that's when they're actually going to start making their overall profits. The author goes on to say that they believe that the fundamentals of NIO are still completely intact, despite overall competition from Li Auto and XPeng. I personally would say that Li Auto is growing very quickly, but I also want to make investors aware that everything that went wrong with NIO over the last few quarters has also gone wrong with Li Auto as well as XPeng. None of these companies were immune to either lockdowns, higher inflation rate, increasing battery costs, and other problems in the Chinese macroeconomic economy. So whatever is happening to NIO also negatively impacted their competition, which is actually good. Now it's a race about which of these companies can bounce back the quickest. The author goes on to say that it's unlikely that the NIO bears will actually be right over the long term, considering that NIO is already on a growth trajectory and in full recovery mode. The financial reporter says that NIO will experience increased demand for its overall electric vehicle offerings as it continues to increase their overall production capacity. The company is planning to build multiple new plants for both battery operations as well as new charging stations and battery swapping stations on top of more manufacturing facilities. This in the future will push NIO to be the top competitor for other Chinese automakers. The overall electric vehicle market is primed for growth, considering that the current compounding annual growth rate for the EV market is around 23.1% for the years between 2022 and 2030. This means that NIO is going to get a huge part of this overall growth, so at minimum, they're going to grow between a 20 and 23% CAGR, if not more, especially if they decide to beat out some of their competitors. Even if they don't gain any more market share and they just continuously grow how they have been growing in the past, this company looks like a phenomenal buying opportunity. The author also highlights how NIO has differentiated itself through its battery as a service power swapping stations that are taking effect over in Europe, but they have yet to be reflected in their overall earnings reports. So for the full year of 2023, we can see this BaaS or battery as a service platform really increase their overall numbers in regards to their revenues and earnings. This is why many investors think it's a good time to buy right now, considering that the share price is discounted based off of less than impressive Q4 2022 results, because many of them are relying on a very strong second half of 2023 and beyond. Now, there are still some problems because, like I said, in the first quarter of 2023, we are anticipated for their next earnings report to not meet expectations. And one of the reasons is because higher than normal battery expenses for the company. According to Bloomberg NEF's annual lithium-ion battery price survey, they reported a 7% surge regarding the average pack prices for electric vehicle batteries. So with higher battery costs per vehicle, this lowers NIO's overall margins. Now, I do want to make it apparent that from 2010 until present day, we've actually seen a very compelling decline in the prices of electric vehicle batteries, which is actually good. However, for the year of 2022, we've actually seen an increase of around 7%, which is not good. We want to hopefully see this continuously go down as time goes on, so these electric vehicle makers can make greater margins. On top of this, NIO has two growth catalysts, and the first one, like we already talked about, is China reopening their overall economy, which means that more demand will be thrusted into NIO and other electric vehicle makers for people wanting to buy more electric vehicles. I would also say that their further expansion into Europe is also a great catalyst, but the best catalyst that I'm looking forward to is during the first half of 2023, they are set to release new vehicles, thus diversifying their overall revenue streams. And these vehicles will then pay off in the later half of 2023 and beyond. As the price currently sits, it's trading between $8 to $9, so it's relatively cheap, but it's not just cheap in their overall share price, it's also cheap fundamentally compared to their overall group peer average. For instance, NIO is trading at just a 2.03 times their EV over C 2023 sales versus their peer group average, which is 2.3 times. Clearly, NIO has a much lower multiple here, making it a better value buying opportunity. And if you can identify value in a growth stock, particularly a growth stock that is trading for this cheap, this is a phenomenal buying opportunity. And Wall Street agrees, considering that the majority of analysts, professionals, and experts on Wall Street believe this company is a buying opportunity. Out of 31 analysts, 23 of them say to buy this company right now, while the remaining 8 say to hold the company. And I want to make it apparent that none of these analysts that were surveyed say to sell the company. The median price target for this company is $16, and the mean price target, which is the average, is $17. And if we compare their current price to their projected future price by the end of 2023, investors can anticipate around 80% upside in just a single year. That's why this author is very bullish, and he recommends looking further into NIO stock, because this company could potentially be a long-term winner for your portfolio, but always make sure to do your own research. I also want to add, when we're talking about buying, selling, or holding stocks, we need to make sure that we are getting our information from a plethora of different sources. For instance, we just looked at a lot of Wall Street analysts that are relatively bullish, but now let's check their ABR, also known as an average brokerage recommendation, is currently 1.94. This is pretty strong considering that the ABR rating ranges from 1 to 5, where a 1 is a strong buying opportunity and a 5 is a strong selling opportunity. Considering that NIO is a 1.94, this means NIO is trading between a strong buying opportunity and a buying opportunity. So overall, we have more inclination to believe that this company is a good buying opportunity from the 9 brokerage firms that were surveyed for this ABR brokerage recommendation. Now, even with that being said, we do have other institutions such as Zacks Rank, which rates NIO as a 4, which is a sell rating. Similarly to the ABR rating, Zacks has a range between 1 and 5, where 1 is a strong buying opportunity and 5 is a strong selling opportunity, and considering they say NIO is a 4, they believe this company is a strong selling opportunity. But the reason Zacks Rank believes this is because they take into consideration short-term earnings per share and revenue forecasts for their upcoming earnings report. And like I said in the beginning, their upcoming earnings report for Q1 of 2023 is going to be less than impressive. We are looking to the second half of 2023, which is why Zacks Rank has a sell rating on this company, but for the later half, I think they will change their mind and change it to a buying opportunity. As far as tip ranks goes, there hasn't really been a recent update regarding about what that institution believes this company is worth. Moving on to our last article, we're going to talk about the top 3 best electric vehicle stocks to buy right now, according to this author. Now, don't get me wrong, there are so many other companies that are not on this list. He just wants to expose you to 3 companies that he believes could have a great upside potential, which is going to be NIO, ChargePoint, as well as BYD. So let's dive into these 3 companies. NIO is the company we've been talking about, and this author also believes that NIO has great upward momentum that they have yet to access, and he believes that this momentum will be triggered at the end of 2023. He also highlights that this company has a very cheap price to sales ratio for such a fantastic growth company, to where their PS ratio is just coming in at 2.8, which is a very low multiple, especially compared to other companies like Tesla, which has a price to sales ratio of 8.6. However, I think if we discount Tesla and NIO's future growth rates to their PS ratio, I think Tesla would honestly be a better long-term buying opportunity, but regarding on which one is a better value opportunity, I would have to say that NIO takes the cake there. However, there are so many reasons to be bullish on NIO, considering that it is very cheap and it may experience a significant rally in the tail end of 2023. So if you are patient and you're willing to hold shares for that long, then feel free to nibble at this company. I personally have much less than a 5% allocation to this company, so you always need to make sure not to over allocate yourself to singular risky growth stocks just like this one, especially foreign risky singular growth stocks such as NIO. Up next, we have another fantastic electric vehicle play that I also own, which is ChargePoint, ticker symbol CHPT. ChargePoint, if you're not familiar with this company, offers electric vehicle chargers for both residential and commercial purposes. They literally have one of the largest electric vehicle charging networks in the United States and China, and analysts project that this company's sales will increase by over 55% this year alone, making the company's fundamentals extremely attractive. ChargePoint also did not have a successful year in 2022, similar to NIO, but this just means it's a better buying opportunity considering that the share price has fallen by approximately 40%. So before they have that big rally in the second half of 2023, you may want to look into this company and potentially buy some shares right now while they're cheap. Currently, this company is trading at around $12.64 per share, and the long-term buying opportunity for this company is absolutely amazing. This company has plenty of catalysts coming up, one of which is directly related to the United States federal government trying to implement 500,000 public electric vehicle chargers by 2023, and ChargePoint clearly can help out with that. Lastly, we have BYD, and I would honestly throw in the honorable mention of Li Auto. BYD, ticker symbol BYDDY or BYDDF, or Li Auto, ticker symbol LY, are both Chinese electric vehicle companies. However, BYD is clearly the market leader over in China, considering its overall mass volume regarding their sales. Many investors who are investing into BYD are focused on the long-term rapid expansion of their overall earnings and revenue. It's also no surprise that Warren Buffett as well as Charlie Munger are key investors in this company. Charlie Munger literally said that BYD surpassed Tesla by a significant margin in overall electric vehicle sales over in China, and he is right about that. However, Charlie Munger also went on to say that BYD is far ahead of Tesla over in China, but I think personally that Tesla will end up catching BYD. But why not bet on both of these companies over the long term? BYD has set its sights on capturing the middle class market over in China, while Tesla is primarily focusing more on premium premium electric vehicles. So they are in competition with one another, but not necessarily direct competition as of right now. But considering that they are in the same space selling electric vehicles, there is some overlap there. So I would love to hear your thoughts about Li Auto, NIO, BYD, ChargePoint, and Tesla. Don't forget to go and annihilate that like button right now for more videos like this one. Subscribe if you are new, and I will see you in the next YT video.